Welcome to today's Daily Report Market Analysis videos with me, Richard Perry, Market Analyst at Hantec, on Friday the 17th of January. There has been a strong risk reaction today, positive moves throughout markets really. Equities showing the predominant degree of that move. We've saw, obviously this week, the signing of Phase 1 agreement between US and China. That sort of put a bit of a floor under the fact that the trade dispute was going to be escalating further. But beyond that, the US economy has come to the fore as being a major driver this week. We've seen decent retail sales yesterday and also some regional Fed surveys that have come out positively, and that really did help to boost risk sentiment yesterday. We also saw decent bank earnings from the big banks. Morgan Stanley joining the party yesterday, and that really did help the S&P 500 to go further into all-time high territory, really gapping to all-time highs and then just continuing higher. So really strong moves that we're seeing there. And actually, if you look at the futures today, they're continuing to show that 0.2% higher on the S&P 500 futures are still climbing. So it's filtered through into risk positive moves through European equities. You saw Asian markets a little bit higher, nothing too decisive, but really strong move there. Also, the safe haven currencies are under a little bit of pressure. The Swiss franc is lower against the dollar, as is the yen, weaker against the dollar. We've seen the 10-year Treasury yield opening higher. So pretty much all moving in the right direction, really. It all seems fairly rosy at the moment. You would still say that, or still question how much further this run higher on the S&P 500 can go. There is undoubtedly the move has been driven by the liquidity operations that the Fed has been engaging in its repo facility operations that it has been expanding the Fed balance sheet through. It's certainly a key driver of the S&P 500, but you can see that with VIX volatility around the 12 mark, this is getting to be pretty low again. And maybe you can argue that you're not a million miles off potentially a little bit of a near-term correction. The dollar's just slipped a slight amount, nothing too decisive. Interestingly enough, the Chinese yuan continues to strengthen. A bit of a blip midweek, but certainly back on track. And we had the Chinese growth data out overnight, which really did show that Q4 GDP came in line with expectations and estimates at 6%, and that meant for the year 2019 was 6.1%. But we did see some strong industrial production numbers and also some strong retail sales numbers as well, which have really helped to have really helped to propel the risk sentiment again higher today. Now, looking further through the calendar, we've got UK retail sales, Eurozone inflation, US industrial production, and Michigan sentiment. So let's just have a look at those. We've got UK retail sales at 9:30, which is not too far off now, but expected to see 2.9% on the year-on-year numbers, so that would be a decent growth of monthly growth of 0.7% in December. Bit of a bounce back from November's disappointing month. Eurozone inflation will be interesting. It's expected to stay around their prelim numbers, 1.3 and 1.4% for headline and core. Into the afternoon, we're then looking at the US data, where the industrial production is expected to decline actually 0.2%, and also capacity utilisation down at 77.1 from 77.3. But the important number I think this afternoon is this Michigan sentiment, expected to be 99.3. Let me show you that Michigan sentiment. And also we're expected to see little tick higher on both expectations and current conditions. So watch out for that. But these numbers are at 3 o'clock, and I think could well be a key driver of markets this afternoon. Now, my chart of the day is the Euro Kiwi. Now, what we've seen is Euro beginning to stabilise a little bit and Kiwi under pressure. And that has shown through with Euro Kiwi, which has rallied in the early 2020 weeks, forming a little uptrend in the past few weeks, but equally breaking this downtrend. So that downtrend now has been broken, and the market's starting to form this run of high lows and high highs. But look at these momentum indicators. They are, or had been, this is until yesterday, had been on a really strong improvement run. Certainly on the MACD lines and the RSI, but also the stochastics as well. Now, yesterday's move has sort of hit that recovery, and it's now started to cross lower on the stochastics. So the question would be, can the RSI hold this improvement? I've stuck the crosshair on 40, which was a bit of a limiting move through December, but now became an area where the bulls came in to support the higher low back a couple of weeks ago. So that's an important area, 40 on the RSI. Obviously, what we also now see is this confluence of the trend lines being tested. Having broken out above the downtrend, that becomes supportive, and also the uptrend is supportive as well. So we've got that at the moment being tested. So the run of higher lows is still intact, and you'd still be looking to use weakness as a chance to buy, but we still need to see this uptrend continuing. I mean, that higher low at 66.90 was important, and I'll show you here on the hourly chart that uptrend and the 66.90 support. So the improvement is still progressing, I think, even though we've dragged back to that uptrend. But you'd need to see, I think, that this support here of the 67.20 area, I think, is important to maintain that improvement. So it's an important crossroads potentially here for Euro Kiwi. So with that in mind, I wish you good luck in your trading. Click here to subscribe to our analysis videos and go to our website to sign up for our webinars.